Hi everyone. In the previous video, we have discussed section A and the first question of section B. And in this video, we will be discussing the second question of the section B, which is talking about Brian and it relates to inheritance tax. So the question goes like, Brian died on 15 February 2025. He had made two lifetime transfers. So this is an important point to remember and as well as the date of death. Lifetime transfers. First lifetime transfer was made on 10th May 2015, which is a potentially exempt transfer and the value after exemptions. Always remember when they mention it is a value after exemptions, that means it is after deducting your annual exemption amount and any other exemptions that are applicable. But here, when we have given about potentially exempt transfer and CLT, there will be no other exemptions. All right. So it has been mentioned after exemptions. So after your 3000 has been deducted, 3000 or 6000 as applicable has been deducted. Okay. On 10th May 2015, it was a potentially exempt transfer of 150,000. Okay. And on CLT, on 20th August 2017 was a CLT where Brian paid the inheritance tax, which means since the donee has paid the inheritance tax, it will be taxed at 25% and not at 20%. Okay, so it is 348,000. So these are the three important things that we'll have to highlight from this. Next, after this, it is going out to death estate. Brian's death estate was valued at 1,250,000. This included his main residence valued at 350,000, on which there was an outstanding mortgage of 100,000. So the value of the main residence would be a net of the value of the residence and the outstanding mortgage. Always remember the value of residence would always be net of any deduction, any payables like the outstanding mortgage. So this is to be remembered. And next, the death estate value is of 1.25 million. All right. His other assets included investments and cash. Okay. The whole estate was left to Brian's daughter, Sophia. Again, it is important to remember whom it is being transferred to. Next, we have Brian's wife, Aisha, died on 20th March 2010. She had made no lifetime gifts and left her entire estate to Brian. Because she had made no lifetime gifts and had left her entire estate to Brian, there would have not been any IHT payable on Aisha's death because it was being transferred to the spouse. All right. Next, we have the nil rate band for the tax year 2009 to 10 and all subsequent years was 325,000. So because they have mentioned the death rate and nil rate band at the time of Aisha's death, this questioning will mostly include about the transfer of nil rate band to Brian on the death of on their death on the account of their death. All right. This is what these are the main points that you will have to remember. Next, here what is the first question they are asking us is what was the gross chargeable amount of the lifetime transfer on 20th August 2017 for the purpose of calculating any additional tax due on Brian's death. So here they are calculating about purpose of calculating the gross chargeable amount is what is being calculated. So usually what is the gross chargeable amount? Usually gross chargeable amount is the amount taxable chargeable for IHT chargeable for IHT after all the exemptions. But here, what is the situation here? Brian is the one who is paying the inheritance tax. So if Dhoni pays the inheritance tax, then the gross chargeable amount is equal to the amount chargeable after all exemptions plus IHT paid during lifetime. Always remember when Dhoni pays the inheritance tax, the gross chargeable amount becomes the amount chargeable after all exemptions plus inheritance tax paid during the lifetime. So for that reason, Now we should calculate the IHT paid during lifetime. IHT paid during lifetime. So when we are calculating IHT paid during lifetime, the nil rate band will not be applicable to any potentially exempt transfers made in the prior 7 years. It is only potentially exempt transfers will be considered for nil rate band only at the time of death and not when calculating IHT paid during the lifetime. So for that reason, the value of gift is 340,000. From that, if we deduct a less nil rate band, as we have discussed, which has been mentioned, it is 325,000 minus 325,000 will give us 340,000 minus 325,000, as it has been clearly mentioned that there were no other gifts other than these two lifetime gifts that were made. The amount becomes 15,000, and this is to be multiplied with 25% and not with 20% that we normally consider. So for that reason, this would be 15,000 into 25%, giving a total of 3,750 is equal to 3,750. That means gross chargeable amount is equal to 340,000 plus 3,750. All right, that will make it a total of 343,750. That is our right answer. With this, we'll be completing our first question. Again, guys, if you are having any doubts or if you're not able to understand any concept, please mention in the comments and I will ensure to get back to you by the end of the day or at least by the second day. And if you are having further any doubts, you can always reach out to me and my contact details will be mentioned in the description. Okay, with this, we will move on to our second question. They're talking about for each of the following statements regarding IHT exemptions for lifetime gifts, select whether it is true or false. Okay, so here they're talking about the exemptions that are available on lifetime gifts. So for that reason, you will not be having to look at the question for most of the parts, but if you'll have to look at it, we can take a look. But other than that, this is a straightforward question. That means these pointers are something that you have already studied during your preparation. You will just have to apply them over here. Okay. First thing, marriage exemption of 2,500 is available for a lifetime marriage gift to a nephew. So marriage exemption is available, but is the amount 2,500 to gift to a nephew? No, it is not, because 5,000 is for the parents for any gifts given by the parents. 2,500 is if it is given by the grandparents or the party involved in the marriage. That is, if spouse gives it to the groom or groom gives it to the spouse or the civil partner is 2,500. But for anyone else, it is only £1,000, which is available exemption. So for this reason, this is a false statement. Okay. With this, we'll move on to the second option, second part of the question, which talks about if an individual makes five gifts of 240 each to five different individuals. You'll have to remember it. Just 240 each for to five different individuals during the tax year. These will be exempt. So this comes under what we must have studied as small gift exemption. Small gift exemption is nothing but if an individual makes a gift which is worth less than £250 per year per individual. So per year per individual, it is £250 is a threshold. £250, £50 per year, per year, per individual. Then it is exempted. Okay. But if you make multiple gifts of £240 to the same individual, then all the gifts will become taxable. Always remember this key point. If you make multiple £249 gifts to the same individual, then all the gifts become taxable. All right. Hope this is clear to everyone. So because of that reason, it is £250 to each to 5 different individuals is being given. So this is a true statement. One person can give multiple gifts of 240, 250, up to 250 pounds to multiple individuals, but to one individual, you cannot gift more than 250 pounds and get an exemption on it. All right. So with this, we'll move on to the third part of the question. If a PET is made, potentially exempt transfer, is made before a chargeable lifetime transfer, both in the same year, the 3000 annual exemption must be used against the PET first, even if it never becomes chargeable. Always remember the annual exemption amount is always utilized on the is always deducted from the gifts, irrespective of whether it is a potentially exempt transfer or a chargeable lifetime transfer. So for that reason, this is again a true statement. Though they do not become chargeable, the exemptions should be deducted from the gifts, irrespective of the type of gift or the nature of the gift. All right. So moving on to the fourth point, it is any unused annual exemption brought forward from the previous tax year should be used before the annual exemption from the current tax year. This is again a false statement because unused annual exemption that has been carried forward from the prior year should always be utilized after deducting your current year's annual exemption of £3,000. It should always be after, but not before. Always after. All right. Want you guys to make notes of these points because these are the points that will be tested. I am sure you must have studied through those, but these small pointers will always be missed out. So it is important when we discuss such pointers, it is important that you make a note of them so you will be able to, these will be able to help you in your exam preparation. All right. With this, we'll move on to our next question, that is talking about the maximum total nil rate band and residence nil rate band available to set against Byron's death estate. Okay, so it is Byron's death estate. The value of the death estate is 1.25 million. And first, we are talking about the total resident nil rate band and residence nil rate band. So for that reason, we should identify if the residence nil rate band is at all available to Byron or not. Here we can see, since the estate is being left to the direct descendants and it including the main residence is being left to the direct descendants, that means the residence nil rate band is available. So first we know what is the residence nil rate band. If you are having a doubt on that, you can always take a look at it. We have our tax tables, which is the most important thing because half the values that you want to remember, you don't have to spend a lot of time in remembering them because these are already provided to you in the examination. All right. So here we know the nil rate band is 325,000 and the resident nil rate band is 175,000. So now taking a look at it, first we have our nil rate band, available nil rate band. Available nil rate band is equal to 325,000 because the total nil rate band is that is available. We're not talking about deduction of the gifts because all these gifts were made before after they exceed the 7 year threshold because they have died after 7 years, that is 20th August 2017. The gift will be carried forward until 20th August 2024, but Byron has died on 15th February 2025. So because of that, the entire nil rate band is completely available for 325,000. All right. So 325,000 is available of Byron. But you can see, as you've discussed earlier, Byron's wife Aisha has also died on 21st March 2020 and 2010, and she had made no lifetime gifts, and the estate was left to Byron. So because of that, her nil rate band was also not utilized. So how much of proportion of the unused nil rate band, it should be multiplied with the nil rate band at the current time. But as we can see, no nil rate band had been utilized. And at the time of Aisha's death, the nil rate band was also 325,000. So that entirely is available to Byron. Wife's transferred nil rate band is also 325,000. So total nil rate band available comes up to 325 plus 325 is 650,000. But they're also asking about our residency nil rate band. Now talking about the residency nil rate band. RNRB, ours is 175,000. We have it available with us completely because it is being transferred to the direct descendants. The same time, spouses is also available is at 175,000. So total nil rate but is available to us would be 325,000 plus 325,000 plus, okay, let's keep it here until this point to identify the differentiation factor, 650,000. But as we have discussed, residency nil rate band is always limited to the lower of the value of the main residence or the residence nil rate band available. It is always lower. RNRB available is lower of the value of main residence or the total RNRB available. RNRB available. All right. As we have seen earlier, the value of the main residence is actually 350,000, but there is an outstanding mortgage, so it should be taken at net value. So it is 250,000. 350,000 minus 100,000 gives us 250,000. The total RN that we the value of property is 250,000, but the total RNRB available with us is 175,000 plus 175,000 plus 175,000, that is 350,000. So value of property or 350,000. So it should always, the amount that we take, it should always be at 250, lower of these both. So we'll be taking 250,000. All right. So the total maximum amount of nil rate band and residence nil rate band available would be 650,000 plus 250,000, making up a total of 900,000. So that would be our right answer. But instead of that, if we take 350,000 by mistake, that would make it up a total of 100,000, and that is where we would be marking a wrong answer. So all these points are to be carefully considered, and for this reason, it is important that you are very thorough and strong with your foundation of all the concepts. All right, with this, we can move on to our next question. Which two of the following would have been deducted or excluded when calculating the chargeable value of Byron's death estate for IHT purposes? They're talking about deductions and not inclusions. Here, the key word for us to remember is deductions. So here, now let's take a look at all of these. A chattel valued at 3,000. A chattel might become exempt for chargeable gains, but for death estate, it should be included in computation of your death estate. So this is not a right answer. Next, Byron's outstanding income tax due, because Byron was supposed to pay the income tax, but he has passed away before that. So this income tax due would have become payable. So it should be deducted from your death estate. So this is a right option. Next is a debt of 5,000 owed to his sister, which is not legally documented. Any verbal promises or any things that are not legally documented debts will not be excluded from your debt estate. So they should not be considered as a part of it. All right. Next, moving on to the next one. Value of Byron's ISA's investments of 45,000. Always ISA investments are, again, any income earned from ISA investments are exempt from income tax, but they are not exempted from your death estate computation. So this value should be included and not excluded. Therefore, this is also not a right option. Let's keep striking through the wrong options for better clarity. Any verbal promises made to your friends or any debts that are not legally documented will not become deductible. Very important point to remember. All right. Next is funeral expenses of £4,000. Any funeral expenses that are relating to the death of the individual, funeral expenses are usually related to the death of the individual, so they have to be deducted from their total death estate calculation. So this is again a right answer. Next is a fee of 900 paid to the personal representative of Byron's estate is again a not deductible from the death estate at all. It is a very straightforward option. All right. These are the things. If so, using elimination purpose will actually help you in identifying the answers. But for questions like these, it is straight up theory. If you're strong with your theory and your foundations of the concept, then you will be able to definitely get your 2 marks over here. All right. With this, we'll move on to our last question. In this, we'll moving on to the last part of the question of the Byron's question. All right. Identify the due date for payment of IHT on Byron's estate and who will be responsible for paying it. Though the assets are being complete, though the estate is being given to Sophia, who is also the daughter of Byron, the IHT payment, the liability for IHT payment will always be lying with the personal representatives and not with Sophia. So with this, we have identified that any these three options can this options these three boxes cannot be the right answer, but it will only be from these three boxes. Now, the due date for payment of IHT. The due date for payment of IHT is always 6 months after the end of the month of death. All right, it is always 6 months after the end of month of death, because Byron has died on 15th February, so the date of death would be the month would be 28th February, and 6 months post this. 6 months post this. So for that reason, it will be 31st August. So 28th February, 6 months post, it would be 31st August. Always remember it is from the month end and it is not 6 months from the date of death. It is always 6 months from the end of the month of death. All right. So, guys, let me tell you the tax administration for individuals, for companies, and all the due dates for corporation tax, inheritance tax, and VAT are very much questionable. Like, you will be getting at least 8 to 10 marks from this concept. So, it is important that you pay strict attention to these concepts so that you will be at good spot. Because if you leave these 10 marks, it would be difficult for you to ensure that you get a good pass mark. So, it is always important that you spend some time to remember the dates and who is responsible for payment and when is the payment to be made. If you are able to remember all the tax administration part of it, you will be at that is when you'll be considered as completely prepared for your examination. All right. With this, we can end this question, and I will see you in the next video. We'll be discussing the third question and the final question of the section B. All right. Bye, guys. Have a very good day and all the best for your preparation.